Welcome to the Hurst Trading Room Live. Today is the 26th of October 2015. My name is David Hickson, and as always, before we take a look at the markets, please make sure that you have read and understood these disclaimers. I thought that we would start today's webinar by taking a look at the euro to US dollar, because we seem to keep postponing our discussion of the euro to US dollar, and it's been several weeks before we've had a good close look at it. And the euro to US dollar poses some really quite interesting questions, which I thought would be useful to discuss in today's. So let's take a look. If you have any questions, of course, please pop them into the chat window. I don't keep my eye on the chat window all the time I'm speaking, because I find that rather distracting. I find it a little bit difficult to multitask in that manner. In fact, as you can see now, when I multitask, all kinds of strange things happen to my desktop. So there might be a bit of a delay after you type a question before I actually get to it, but I will try and get to all of your questions. So let's take a look at the euro to US dollar. That chart that you're seeing there is the long-term chart that we've been looking at in the Hurst Trading Room. That's got data going back to 2003, I think. I start my analysis in 2005, and let me just speak for a moment about that, because that's a question that I have answered in previous webinars about choosing your analysis period. But it's something that a lot of people get very I wouldn't say worked up about it, but they get a little concerned about whether they've chosen the correct analysis period. And you can see here I have chosen an analysis. What does all this mean? Well, when Sentient Trader performs an analysis, you can throw all the data you have at the software, and it will analyze everything and try to identify the positions of cycles. Occasionally that causes problems, and the euro to US dollar, well, this particular selection of data that I have is a good example of why it might cause problems. You can see over here, way back in 2003, there's a trough very close to the left-hand edge of the chart. Now, as humans, we have imagination, and we're able to say, well, perhaps just a few weeks or a few months before that trough, which looks very impressive, but perhaps just a few months before that trough formed, price was at a lower level, which means that if we were able to zoom out, I'll do a little sort of a drawing on the right-hand edge of the chart. We have a trough forms at the left-hand edge of the chart, and it looks very impressive because price hasn't dropped below that for several years, for many years. In fact, it only just dropped down to that level earlier this year. So if you show that data to Sentient Trader might say, well, this is a really impressive trough, because look, it's been 12 years since price has dropped below that. But of course, we know that if we were able to zoom out, we might see price dropping down below it. Inevitably, any data series that you analyze or that you obviously has a starting point, and to the left of that starting point, you don't really know what happened to the data. So you can sort of end up chasing your own tail and trying to get more and more and more data, going further and further back in time. But there's an easier solution, which is simply to tell Sentient Trader to actually ignore the first little section of data. So we tell Sentient Trader, ignore that. And the way that we do that is by specifying an analysis period. And the way in which I do it, and the way that I recommend doing it, is you look at your data troughs from the left-hand edge of the chart. Which of these troughs could you actually guarantee is a fairly important trough? It doesn't have to be a very important trough. You don't have to identify the 18-year cycle trough, obviously, but you want to be saying, I can definitely say that that trough is a trough of at least, and as a rule of thumb, you want to find a cycle length that you could fit 4 of into your data. So in this particular case, I'd be looking for a trough that I could say is at least 40 weeks in length, perhaps 18 months in length. And so the first trough that actually could be identified as being definitely of at least 40 weeks to 18 months in length is this trough over here. You then go back in the data and you provide a point before that trough as your analysis start period. If you are working with the beta version of Sentientrader, which is able to perform a double analysis, then you might want to include the peak that precedes that trough in your analysis. You set your analysis start period over there. Okay, so that was a long discussion about that. So here is our analysis of the euro to US, and let me give you a few of the highlights. First of all, in was that I think it was November of 2005, there's a very big, very prominent trough, which was probably a trough of the 4.5-year cycle. The next very big prominent trough was in June of 2010. The trough of the next trough of the 54-month cycle, and I believe that the next trough of the 54-month cycle occurred in March of this year, March of 2015. Now, when it comes to speaking about long cycle troughs, I often say rather glibly, well, I'm not really very worried about where that 54-month cycle trough goes, and perhaps I've caused some misunderstanding because of that. I'm not really that careless about the positioning of the long cycle troughs, but I'd like to clarify what I mean by that. When it comes to identifying very long cycle troughs, it's quite easy to get it wrong because we have a very long cycle trough over here in, I think that was June of 2010. So, of course, 54 months later, we're expecting the big trough of the 54-month cycle to occur again. And I see a question from Bob, and I'll get that question in a moment, Bob, and speak about that. It's quite an important question. So we are expecting, of course, the cycle of the 54-month cycle trough to form in the markets. And in fact, I started writing about the anticipated 54-month cycle trough towards the end of last year, I think. So, I was anticipating it 3 or 4 months before it probably occurred. The important thing about performing a cyclical analysis is that when you're anticipating a particular trough, and this could be any trough, whether we're talking 54 months or 40 days, when you're anticipating any trough, you can only know with 100% certainty that that trough has occurred once quite a lot of time has passed. And quite a useful way of demonstrating this is to use the FLD. So let me just pop up the FLD for the 54-month cycle, and it doesn't want to show it to me because I don't have it in both analyses. Here we go. So here's the FLD of the 18-month cycle trough. Now, in theory, we would only really know with absolute certainty that the 54-month cycle trough has occurred once price crosses up above the 54-month cycle FLD, or in this case, I'm looking at the 18-month cycle FLD, and I'm unable to plot the 54-month cycle FLD because there's an issue with the beta vert if you don't have 54-month cycles in your peak analysis. So that's something that's in. But you can see the issue. The issue is that you have to wait a long time before price rises up to that FLD. Now, this trough, I believe, occurred in March of 2015. Here we are in late October 2015, and price has still not crossed the 18-month cycle FLD. So I still am not able to be 100% certain that that trough has occurred because price hasn't crossed the FLD. And yet I need to be making trading decisions. I don't want to wait you know, how many months is this? I don't want to wait 7 months for confirmation that an 18-month cycle trough has formed in the market. And so, of course, we use the principle of synchronicity and the principle of harmony, which tells that troughs occur at the same time in the market, and therefore when price crosses a much shorter FLD, we can use that as evidence that the trough has occurred. So for instance, you might way back in March used the 80-day cycle FLD as confirmation that that really long cycle had formed in the market. And when price crossed up above the 80-day cycle FLD, which it did sometime in April after the formation of the first 40-day cycle, when it did that, you could have said, I am now confident that that really big trough has formed. And of course, in fact, you are only 100% certain that a trough of at least 80-day magnitude occurred. You cannot be 100% certain that the trough of 54-month magnitude occurred. But because we were expecting a 54-month cycle to occur, and because that cycle had to occur synchronously with all the shorter cycles, we had good reason to believe it. So I sometimes say rather glibly, you know, I'm not really about plotting that diamond for the 54-month cycle, because I'm not yet confident that that is the 54-month cycle trough. It's a very important aspect of performing a cyclic analysis. You have to get used to working with not absolute certainty, but you work with probability. You work with the fact that because we're expecting a big magnitude to occur there, and a trough did occur, then we know that that is certainly a trough of at least 80-day magnitude. It is probably a trough of 20-day magnitude, and it is very likely to be a trough of 40-week magnitude, and I expect it to be a trough of 18-month magnitude. Do you see how your level of confidence sort of decreases as you go up the scale? The important thing when you're making trading decisions is to work out what level of confidence you need. Now, I trade, well, actually most of the trading I do now is intraday, but what we speak about in the Hurst Trading Room and what we do on Hurst Signals, of course, is end-of-day trading, and we're looking at trading a pattern that occurs within every 80-day cycle. And so my time frame for confidence needs to be only at about the 80-day cycle level, and it can generally be even shorter than that. So if a trough occurs and it is almost certainly a trough, well, let's say we are 100% certain that it was a trough of at least 20-day magnitude, then that is enough confidence for me to start trading on the basis of the formation of that trough. Of course, I am also expecting that that trough will be a really big magnitude trough, but it doesn't. I don't have to be correct about it being such a big magnitude trough in order for me to make successful and profitable trading decisions. I hope that makes sense. It's quite an important point. When you're performing a Hurst cycle analysis, sadly, you can never be 100% certain. You know, I dream of being 100% certain of these things, but it's never possible. But what you can do is you can be certain up to a certain, up to a level of magnitude, a degree of magnitude. So I hope that makes sense. To Bob's question, Bob said, is there a reason I don't have more historical data for analysis? And actually, Bob, as Mark says, the euro started really trading in 2002. So yes, that is one reason, is that if you want to find euro data prior to 2002 or 2000, you have to work a little bit harder to get it. That's one reason, but that's not really the reason why I'm showing you a chart that only goes back as far as 2000 and early 2003. The reason that I'm doing it is because I find an analysis based upon this much data is adequate for me to make trading decisions at the level of the time frame that I'm interested in trading. And it's another question that we often get from new Sentient Trader users. They say, how many years worth of data do I need? And when I started developing Sentient Trader, and it was called the Hurst Trader, one of our early beta testers, who's with us today, I believe, yes, I can see you there, started working with data going back to 1898 in the Dow, and that was fantastic. You know, obviously, the more data you have, the more information you have about the cycles that are operating in the market and that are working in the market. But there's a balance between how much information do you need to make successful trading decisions, and how much data do you need to you know, really refine your analysis. Yes, Bob, as you say, more data will increase your confidence in the 54-month and 18-month analysis. But you know, it's not a straight line curve. In fact, let me see if I can sort of demonstrate this. Here we go. I think this is going to show you a whiteboard. You should be seeing a whiteboard, I think, on the system. So you know, if we plot a graph in terms of let's see. The vertical line I will call confidence. I'm not going to try and write confidence there. So I'll call that C. That's my confidence in the analysis. And this graph here is the amount of data. So the more data you have, more you move to the right-hand edge of the chart. And so if you have very little data, your confidence in your analysis will be very low. As you add more data, your confidence increases. But it's one of those graphs that does that kind of thing. You reach a point where the more data you add, the benefit to adding that much data doesn't really increase that much. I hope that makes sense. So yes, adding more data will increase your confidence, but it doesn't increase your confidence that much. More important in my opinion, and you must understand this is just the trade with Hurst cycles. We've got some very experienced Hurst cycles traders with us on the webinar today. They come along every week. I'm very pleased to see them, and I know that many of them have a different approach to me. So it's important that I make it clear this is my approach. My approach is not to worry too much about where that 54-month cycle trough is. I don't even worry too much about where the 18-month cycle trough is. And the reason for that is because if I am confident that, let's just zoom in here on this chart again. If I am confident that trough that is formed is of at least, and let's just speak about this actual situation in March. And I would encourage you to go back and look at blog posts that I wrote during this time. Because you know, writing blog posts is something I really, and blog posts have almost become a little bit of a trading journal for me. I write a blog post and I can go back and I can say, I can ask myself, what was I thinking about the analysis? And if you go back to March, you will see that I did start considering this trough here. In fact, I first of all started considering this trough here in January as the big trough that I was waiting for. And so what I started doing was I started watching the FLDs and I started watching the cycle shapes. And I wrote about it in the blog. You can see my thought process. When I'm expecting a very big cycle trough, I don't jump into the market too soon. And I ask myself, what is my level of confidence in this trough? And in January, my level of confidence wasn't very high, but I did say to myself, I'm going to watch. Let me just zoom. I hope this is going to prove to be quite an interesting point. I'll just zoom in like that. There we go. And I need to turn that pen off because for some reason it's popped up a data window. There we go. Okay, so here we go. In January, my level of confidence wasn't very high in trough, but if you have a look, after, let's say, 10 days after that potential trough at the end of January. Interestingly, that was over the weekend of the Greek elections. Very interesting to see how news acts with cycles in the markets. So price jumped up. I didn't jump into a trade saying, yes, the 54-month cycle trough has occurred, because that would have been really premature and very dangerous. What I did say, watch the first 20-day cycle form in the market, and then the first 40-day cycle form in the market. Now, when the first 20-day cycle had formed, it looked quite nice and bullish. Now, remember, I measure bullish shapes or cycle shapes according to where the peak is. So a late peak is an indication of a bullish cycle, and a trough which forms at a higher level is another indication. So we had a fairly bullish 20-day cycle trough. But what I wanted to do, because it was such a big cycle trough that I was anticipating, was I wanted to see the first 40-day cycle shape. So what happened to the first 40-day cycle? Came down horribly. Okay, so that was not a bullish 40-day cycle. Clearly, it was a nasty bearish 40-day cycle, and so that trough was effectively eliminated from my consideration. But I went through the same thinking process again, and that happened in March. So another potential candidate for a 54-month cycle trough formed, and I looked at my level of confidence, and I was fairly confident, looking at the breakdown of the analysis leading up to it. I was fairly confident that that was a trough of at least, if memory serves me correctly, of at least 80 days and probably at least 40 weeks, which meant that it was very likely to be the trough of 54 months. But again, I didn't jump into a trade. I watched the first 40-day cycle form in the markets, and there's that 40-day cycle, as you can see. And I wrote a blog post about it, in particular because it's a fairly neutral shaped 40-day cycle, which is something that you do sometimes see following a very important trough forming in the markets. It's quite an interesting thing. The markets aren't perfect, and you don't always see that instantly very bullish cycle happening on a very short scale. Having seen a neutral shaped 40-day cycle, I was fairly confident, of course, only if price bounced out of that trough. So let me be quite clear here. I was confident in the magnitude of this trough here in March being a trough of, let's say, at least 40-week magnitude if price bounced out of this 40-day cycle trough and left us with a neutral, slightly bullish 40-day cycle. So, of course, at that point, I started looking at the FLD, and the FLD doesn't go that far back. Sentient Trader doesn't got it that far back, but the 20-day FLD, let me just see, would have been doing something like this, and so I would, of course, have set my entry level at the level of price crossing that FLD, because when price crossed that FLD, that this was definitely a 20-day cycle. And because of the amount of time that had passed since the trough, I was then very confident that this was a trough of the 40-day cycle. The fact that it was a 40-day cycle trough meant that I was very confident that this was a trough of at least 40 weeks. Yes, I expected it to be a trough of 54 months, but it wasn't very important to my trading that it was definitely the trough of 54 months, because if this was a trough of 40 weeks, I nevertheless expected to get some good profitable trading out of it, and of course I did. I got some good profitable trading using that 20-day FLD as price bounced out of that trough. So that's a really long, complicated answer to the question, why don't I have more historical data? Because in my opinion, the more data you add, perhaps gives you slightly more insight, and it enables you to better position your 50 cycle. If we added more data, we could start speaking about the 9-year cycle. Yes, that would be useful, and it would definitely increase your confidence in the analysis. But when it comes down to the finer detail of trading, which is really what I focus on, it adds a little bit of extra information, but it doesn't add enough extra information to really dramatically change the way in which I'm trading. Because my trading, I'm focused on a particular time frame, and you should understand that. I'm looking at the 20-day FLD. I'm looking at 80-day cycles forming in the market, and that's really what I'm tracking. So some other questions there. Connor, great to be here. Great to see you here, Connor. William Hurst stated in the cycles course that one of the biggest mistakes students make is using too much data. So that's a really interesting point. And I know William has studied the Hurst cycles course in great detail, and it's a really interesting point. One of the mistakes that students to Hurst cycles make is that they think that more data they get, the better their analysis will be. That's not necessarily true, because there is a scale of diminishing return. Yes, if you add more data, you can perhaps get better analysis. But one of the other disadvantages of having too much data, and you should be aware of it if you're using Sentient Trader, some people think the more data you have, the better you can work out the wavelength of a particular cycle. And that's not really true, because Sentient Trader, when it works out the current wavelength of a cycle, doesn't actually go back very far. Well, it does for the 54-month cycle. It does. It goes back 6 cycles, in fact. And if it has 6 cycles, it'll use those 6 cycles to work out its average. But you are aware that cycles are constantly varying. The principle of variation tells that the wavelengths are constantly varying. And so the average wavelength of the 20-day cycle in 2006 probably doesn't have a lot of bearing on the length of the 20-week cycle now, 9 years later. Okay, I hope that makes sense. Connor, using date of birth, 1st of January 1999, astro cycles show major moves on the euro. Okay, that's very interesting. I've had many people share astrological discussions and approaches with me, and how they relate to Hurst cycles. I do believe there is certainly a connection between an observation of the planets and the planets' movements and Hurst cycles. There's definitely a connection. I'm not sure what the connection is necessarily, but it's very interesting to see how the two work together. John says, why do you speak about a 40-day cycle when they don't appear to have a corresponding color in the reference diamond bar at the right? That is the 32 diamond. Okay, and David says it needs Sentient Trader needs a nudge. I think perhaps that was a sort of moved on from there. If I go back again, one of the problems. There we go. I was speaking about this area over here, and I was speaking about this 40-day cycle here, but perhaps that's the point of your question. I'm not sure about that. Okay, so take a look at what the euro is doing now, and let's speak about what we're expecting. So that was a really long sort of discussion about the background to this analysis. So here is the analysis moving forward from March of this year. And where are we? Here we go. So here is the 54-month cycle trough in March of this year. Now, that still looks good to me as a 54-month cycle trough. But as I've mentioned, I don't mean to disregard the longer cycles, but it might turn out, with the benefit of hindsight, that it wasn't a 54-month cycle trough at all. it might turn out, with the benefit of hindsight, that perhaps it was only an 18-month cycle trough. I think it was definitely at least a 40-week cycle trough. And if that disconcerts you, then I'm going to say it again. I'm trying not to repeat myself too often, but the important thing is on your time frame for your trading, and work out your level of confidence on the basis of that. So what has been happening since then? Well, of course, price bounced up and then came down into the 20-week cycle trough over here, and price bounced up again. Now is heading down into this 40-week cycle trough. So the next sort of fairly big event that we're expecting is towards the end of December. No, not December, end of November. We're expecting a 40-week cycle trough to form in the markets. And let me turn on those semicircles, because the semicircles do often make the visualization of the cycles that much easier. So here is the 40-week cycle trough according to this analysis, which has been bouncing up and is now going to go down again. Of course, we've got our nice M shape forming in the markets, and so we're expecting price to move down into that 40-week cycle trough at the end of November. And so before we take a little more detail, let's see if there are I see a comment from Craig. Is it a similar situation for intraday? Is the data required the same sort of correlation, 80-day cycle, 20-day FLD? Is there a specific equivalent intraday? 15 minutes, 2 hours, something else. Okay, Craig, yes, intraday. Intraday is a fascinating, and we are going to be doing a webinar where I am going to speak about intraday. Intraday, many very interesting things happen, and it's a whole different kettle of fish, actually, intraday. To some extent, the principles that we look at end of day do get extended intraday. Yes, so you have we have a nominal model that extends all the way intraday, and that nominal model has a roughly 1-day cycle, and then we can break it down into either 8-hour or 5-hour, depending which nominal model you go with, from 5-hour down to about 3-hour. I work quite a lot with a 163-minute cycle, and you can bring it down to hourly, half-hour, 15-minute. You can have a lot of debate about what nominal model works intraday. We will when we do the intraday webinar. One of the reasons I'm delaying the intraday webinar is because the beta version of Sentient Trader has a new, very exciting approach to working intraday, which we haven't even started testing yet. We're going to be starting testing it very soon. It has an interesting approach, which makes the assumption that the nominal model, when you're looking intraday, is in fact what I call a dynamic nominal model. I'm really off on a tangent here, sorry about that, but seeing as you mentioned intraday, I'll quickly give you a little bit of detail. The new version of Sentient Trader is able to perform intraday analysis on the basis that the nominal model is dynamic, which is a sort of a deviation from Hurst's original principles. But the basic concept is that you still have a nominal model, but it's dynamic and it is changing all the time. So we'll speak a lot more about that when we get to speaking about intraday. There's a lot to talk about. But if you speak to any Hurst analyst who trades intraday, you'll find they're constantly searching for the ideal nominal model. In my opinion, the ideal nominal model is like a shadow that you're trying to chase. It doesn't exist, and that's because for every example of an intraday chart where you find the 1-day cycle breaking down into 5-hour cycles, I can show you examples where it breaks down into 3 8-hour cycles, and somebody else will show you examples where it breaks down into 2 12-hour cycles. Okay, so and as William says, modulation is very high intraday, and that's right. The modulation is very high, and there are other aspects of working intraday. For instance, the shorter time frame you get, the greater is the intraday noise caused by all kinds of things, you know. So there's a lot of noise. Anyway, that's a real deviation. But in principle, Craig, yes, what we're speaking about end of day, the same principles apply intraday because we're still working with cycles. Potentially those cycles get a little more complicated. I believe they do. I believe they become dynamic and modulate all the time. Their wavelengths are changing, and they're changing in a way that's quite difficult to track. But anyway, that's enough. We are going to be doing a webinar about intraday, and I know many people of that webinar. It's a very, very popular subject. Trading intraday, I must tell you, is using Hurst cycles is a fairly demanding process because you're having to perform an analysis, go through a lot of thought process, and then produce your trade. So it's a big subject, but we will get there. Okay, so let's just take a little more detailed look at the analysis that we're sort of gradually working our way through here on the euro US dollar. It's tossing up lots of other interesting considerations. So as I was saying a few minutes ago, of course our next big event is for price to come down into this 40-week cycle trough. Now there's something important to mention here. I didn't really have a theme for today's webinar, but it seems to me the theme perhaps has to do with the placement of the very long cycle troughs and the shifting of those very long cycle troughs, which I never worry about very much, but some people do, so we do need to speak about. And okay, so Craig, that's great to hear I've answered your next question. Good. You shouldn't get me started on intraday. I can speak about intraday for many hours. We'll be here a long time. So the point here is that price is coming down into this 40-week cycle trough. Now, if the placement of this 54-month cycle trough is correct, if that is the 54-month cycle trough, then of course the first 40-week cycle follows it. We would expect to occur above that trough. I say we would one of the big differences between Hurst cycles and Elliott wave is that Elliott wave has harder rules about, wave one. We've got one, potentially here, and we've got wave two happening here. Now, wave two in Elliott wave principle must occur, above the start of wave one. So you have to have it kicking up before that, and Hurst cycles don't have those hard and fast rules. So it is actually possible, unlikely but possible, that the 40-week cycle trough could drop below the level that we saw in March. But now the interesting point about that is I've already said in today's webinar that although this trough is marked with being of 54-month magnitude, I don't discard that, but my confidence in this trough, which is a slightly separate thing, my personal confidence in this trough is at the moment only high as the 40-week level. It might be 18 months or 54 months, but my confidence level is at 40 weeks. So before the end of November, or not before the end of November, but by the end of November, I expect to see my confidence in this trough in March tested. Because you see, if price drops down below that level, it will then form another trough and bounce up again, which will be a trough of the 40-week cycle. But if it forms lower than the trough in March, then I would reconsider the placement, and not just me, but Sentient Trader will reconsider the placement of the 18-month cycle trough and the 54-month cycle trough. But that doesn't worry me as I make my trading decisions, because I know that price is coming down now into this 40-week cycle trough. And so short trading opportunities as it comes down into that 40-week cycle trough, and there should be good short trading opportunities. When price comes down into a trough, it does what we call a plunge. Well, I didn't invent that term. Some of our Australian beta testers invented that term. It comes down into the trough with a plunge, and it comes out of the trough with a bounce. And so the plunge into the 40-week cycle trough should be quite good, and you want to be trading short, of course, as price goes down into that trough. You want to turn around and trade long as it bounces out of it. If price drops down way below the level that we saw in March, then we're looking at not just a 40-week cycle trough, but potentially a much longer cycle trough. So again, I won't jump into my long trades if that happens. I would watch the first 40-day cycle form and see how bullish it is, and then do the whole process all over again. If the 40-week cycle trough forms above the low in March, that is what we would expect, and I would get into my long trade slightly earlier, because my confidence in the magnitude of that trough would be very high at it being a magnitude 40-week cycle trough, because the trough is forming higher than the low in March. I hope that makes sense, and I hope it's proven to be a useful discussion. Bob says, please show the composite model. Yes, I will show the composite model. And now the composite model I've spoken about previously in these webinars, and I don't need to rebuild it. I just need to turn it on. There we go. Okay, so that's the composite model for the euro US dollar. I hope you can see it. In fact, one of my feature requests was a model line and more visible, because I keep finding I can't really see it. It's because one of our developers made it a sort of parent line. They thought it looked very interesting as a transparent line. Even when you change the color, it sort of gets washed out, and so that's why it looks a little bit like that. But hopefully soon it'll be a bit more visible. But here is the composite model line. Just a reminder to all of you what the composite model line is and what it isn't, which is equally important. The composite model is something that Sentient Trader puts together after it completes an analysis. And what it does is it takes all of the cycle information that it has, and it has a lot of information. It knows when cycles form troughs. So bear in mind, this line was not a forecast line, back in March. So back in March, the composite model line was not necessarily forecasting exactly that. It's important to bear that in mind. But what Sentient Trader does is it takes all the information it has, and not all the cycles, but the cycles that I choose to include in the composite model line. And you can see here I'm including sigma L, the 54-month cycle, down to the 20-day cycle. Not the shorter cycles. If I include the shorter cycles, I get several more wobbles and so on, including some rather sort of over dramatic models, wobbles over here. That's because it's reading the 10-day amplitude as being very high, which is probably a mistake. But it takes all of this information for all the cycles that I choose, and it puts that information back together again. And so if the markets were perfect and they worked only according to the cycles, in other words, there wasn't any other interaction, and we all know there is a lot of other interaction. But I see that's always a little disconcerting when Adobe Acrobat updates while I'm doing a webinar. Anyway, hopefully you're all still seeing the screen. So the composite model is the combination of all the cycle information that the software has. And it isn't a big surprise that it follows the price action fairly closely, because of course we have extracted that cycle information from the price movement because of our analysis. And then what Sentient Trader does is it plots that composite model line over the price so that you can see how closely the price action follows the composite model line. And generally there are two really useful things that you can gather from your composite model line. First of all, when you look back, you look at the past, you can see how closely that composite model line has matched the analysis. Again, the composite model line is not terribly clear on this chart, but I hope you're able to see it clearly enough. Most of the time, the composite model, which is really just our pure cycle information. So if all you knew about the euro US dollar price movement were the cycles, then that sort of orangey line is would have expected. And most of the time, as you can see, the composite model line very closely. There are periods of time, from the beginning of the analysis all the way up to about here, where the composite model line follows price very closely. That indicates that our analysis is accurate during that time. It's showing us that the cycle information we have explains a lot about the price action. So we're able at the time to derive that cycle information and had been performing a good analysis at that time, then we would have very accurately been able to model what the price was doing. Okay, there was a little bit of sort of a drift of price away from the composite model line over here. But here, over here, quite importantly, there was quite a big deviation from the composite model line and the price line. What does that mean? What it means is that our cycle analysis that we've performed on this chart doesn't match price as very closely during that time period. So I find it very useful to plot this new model line and then to zoom in and go and have a look at those time periods and work out what it is that might have been wrong with our cycle analysis during that period. What was wrong with our cycle analysis? Well, it might jump out at you. If it jumps out at you, that's really good. Here is the 18-month cycle trough, according to this analysis, in early 2012. Here is the first of the 18-month cycle shape. Here is the 40-week cycle that occurred in July of 2012. And then here's the cycle shape continuing. And here is the next 18-month cycle trough over here in July of 2013. What is wrong with that? Well, we know that cycles make M shapes, and usually we expect the middle trough, lesser magnitude trough, to be a less impressive trough in price. What happened here was what I call an inverted cycle shape, which is not an inverted cycle. There's so many terms, I know it can get a bit confusing. I call this an inverted cycle shape simply because the central trough, which was of only 40-week magnitude, dropped down below the start and the end point of that 18-month cycle. And you can see how that discrepancy, or that, I wouldn't say it's an error, but it's something about the analysis that is not ideal. So that situation in the analysis is what is causing the issue with our composite model line. But our composite model line, remember, is using the cycle information. So our composite model line is drawing us a very M shape for this 18-month cycle using the measured amplitude of the cycles during that time. And it is saying that using the cycles that it has found in the market at that time, that is what that price movement should have looked like. So there was a discrepancy between our composite model, which is the result of all our cycle analysis, and the price movement. That discrepancy is something that does cause us some concern, because it's an indication of there's something about this analysis that's just not really quite right. If you're a bit obsessed about analysis as I am, you will want to sort of work on the analysis and see how you can improve it. And I'll show you in a moment how I've been able to do just that. But before we take a look at that, let me point out something else about this composite model line, which is the other aspect of the composite model line, which is using it to project into the future. But the way in which you use the composite model line is that you don't look at specific price levels. The one thing the composite model line is very good at getting right most of the time is that when price moves up, when the composite model line moves up, it indicates that many cycles that are working in the market are moving up. So even though our specific price levels here are wrong, you can see that the general shape of the composite model is in fact fairly good. I'm sort of drawing on this chart without really meaning anything. So here we had a composite model line moving up, and here we had price moving up. Here we had a sort of a correction. Composite model line was correcting during this time. Here we had price moving down. The composite model line was moving down. Here we had composite model line moving up. Price moved up. Composite model line moved down. Price moved down. So you can see that the price movements are in sync with each other, but the degree of the movement is out. It is incorrect. And that's because of the placement of those longer cycles. And that is one of the reasons why I don't obsess too much about the placement of those. As long as I am confident in the placement of a cycle such that I can make confident trading decisions. And as I've mentioned, I'm confident in the trough in March being of at least 40-week magnitude. That's my confidence level in that trough. And so I've made some great trades in the euro US dollar since then on the basis of that confidence level. It might be the 54-month cycle, but I'm not confident enough yet in that. But I don't need to be confident in it because my trading decisions are at a much shorter scale. And so you know, an interesting moment there. I see a question from Urian. I'll get there in a moment. Before I get to that question, let me show you one way of resolving that. I'd like to have an analysis where I can look at a chart. Let me keep that scale. I like to have an analysis that answers all the questions for me. When I see a composite model line that deviates from price, it bothers me because I know that there are some issues in the analysis that really aren't quite correct. And so I mentioned in our previous webinar about the euro to US dollar. I look at this analysis and I asked myself whether in fact it was possible that the nominal model I was working with, which is Hurst standard default nominal model, wasn't correct. And the reason I asked myself that question is because we have a 54-month cycle trough here in 2005, 54-month cycle here in June of 2010, and possibly another 54-month cycle here in 2015. And the nominal model that Hurst uses and the nominal model that we use for everything else has a 3-to-1. I can never draw those that colon with this pen. Has a 3-to-1 harmonic ratio. So we expect the next shorter cycle to be 18 months, and we expect there to be 3 iterations waves within each 54-month cycle. So I asked myself the question, is it possible that in fact we have a different nominal and we have a 2-to-1 harmonic ratio? Okay, and so that's what this analysis does. I'm not convinced that this is the solution to the euro to US dollar, but it's a very interesting analysis to look at in my opinion, and so that's why I created it. And if we look at the composite model line on this analysis, and there we go, then you will see that the composite model line here is, let me turn off the semicircles, works much better over this period of time. And you see how, let me turn the pen on again, can you see how during the period in 2012 where we had the issue on the other analysis, that issue has disappeared here. We have a really good, very accurate composite model line operating during this period. You can see the composite model that we're working really matches price very closely. But that highlights a danger with the composite model line, in my opinion. you have to be careful of adjusting your analysis or refining your analysis too much using the composite model, because then you end up with an analysis that matches what's happened in the past very well. But will it match what's going to happen in the future? And that's always the very big question. I always keep a default analysis on any instrument that I analyze and trade, because if you refine your analysis too much, then in my opinion you expose yourself to the danger that you have sort of over refined your analysis, and that your composite model line or your analysis is not really going to prove very useful. And this is demonstrated quite well in the euro US dollar, because using this unusual nominal model, can you see what's happened recently? The composite model line has been deviating quite strongly from price. Why is that? Well, it's cycle information that it has, of course. That's always the answer to any composite model questions. Why is it deviating? But in particular, it's because I'm using a nominal model here that tells me to expect not 3 cycles of 18 months in length, but 2 cycles 27 months in length. And so we're presented with an interesting situation. We have two analyses. The one analysis looks very good historically, but recently it hasn't been very good. The other analysis has a few issues about 3 years ago, but recently it has proved much better. And so how do I resolve that? Personally, I don't believe it's necessary to choose one analysis over the other. I look at both of them and I ask myself, what is in common with these two analyses? And unfortunately, because I'm working with a different nominal model here, unfortunately, the colors of the cycles are different. So this looks like a different magnitude cycle, but in fact, it isn't. This is also the 40-week cycle trough that price is coming into. When we zoom in and take a look at recent price action, you can see that we are expecting very much the same thing. And in fact, let me not sort of gloss over the details. Let's do this a little more carefully and really consider these details, because they are quite interesting. According to this analysis, and this is what I call my 2-to-1 ratio nominal model, it has a 2-to-1 harmonic ratio between the 27-month cycle and the month cycle, as opposed to a 3-to-1 harmonic ratio between the 18-month and 54-month cycle. And you can see that at the moment, price is expected to come down. We've got a bit of a wobble there, and it's expected to come down to form this 40-week cycle trough over here, which is expected towards the end of November. Now, what is interesting about this is that the composite model line at the level of the March trough, whatever magnitude trough that was, but at the level of the March trough, the composite model line was at about a level of, what is that, about $1.07.5 to the euro. And the composite model line is telling us that it is expecting price to drop a little bit below level. Can you see that? Okay, so we should stand by for price to potentially drop a little bit below that March trough. It's a possibility. However, this analysis also told us to expect the trough in July of this year to occur below that trough, and it didn't. Okay, so the fact it didn't means it is probably more likely that the other analysis is the correct one. So let's go and have a look at the other analysis at roughly that same time frame. And so that was something like this. Okay, so here it is here. Here you'd see the composite model line tells us a drop from about this level down to about this level. How much of a drop was that? Remember that with the composite model line, you don't look at exact price levels, but the scale of the move does reflect the measurement of the current cycle amplitude. So the scale of move is an appropriate thing to look at and talk about. So it was expecting a move from about $1.1550 down to a level of about 109.50. So that's about 6 cents. So we were expecting a drop of about 6 cents in the euro. So far, the euro has dropped from that high of 15 down to about 109.80. What did it get to on Friday? Something like that. And so it's dropped about 5 cents. So according to this composite model line, we would expect it to drop a little bit further. But more importantly, we're expecting that trough to occur only towards the end of November. So there is still a bit of time. However, these cycles vary, of course. So the wavelengths, might be shortening, and so that trough might occur a little bit earlier rather than later. So the composite model line is very useful, in my opinion, to tell us what we should expect, but it's also important to bear in mind that the composite model line is based on the idea that the cycles that are currently operating in the market will continue to do so with the same wavelength and with the same amplitude. And so we have to adapt ourselves as we see those wavelengths potentially contracting. Now, the strong move down last week occurred earlier than the composite model line was telling us to expect it. The composite model line, as you can see, let me just clear all this and start scribbling afresh. So there was the week. The composite model line was looking at, but it was looking at it occurring about 2 weeks later. Is it possible that the cycles have sped up a little bit, and that we're seeing things happen 2 weeks sooner? It is absolutely possible, yes. So I think it's very possible, dare I say likely, that price is already moving down into this 40-week cycle trough, and we would probably expect the 40-day cycle around about now, and cause that little wobble that we see in the composite model line, and then see price come down one more time into the 40-week cycle trough, which might occur a little bit early, because it does look as if though the cycles have been speeding up and things have been happening a little bit sooner. So that's the current situation in the euro to US dollar. And I said I would answer a question. Urian, does changing the nominal model affect the A to H sequence as used in the FLD strategy? Yes, Urian, it does. It does very much. I'm not sure what version of the FLD trading strategy you've done. I think you've done the full version. If you work with the full version of the FLD trading strategy, let me just go to the whiteboard and clear this. How do I clear the whole thing? Let me start a new whiteboard and see if that works. There we go. Okay, so the FLD trading strategy works on the basis of there being 8 interactions between price and the FLD, and they're labeled A through to H. And that interaction sequence, I don't know why my lines looking also askew. That sequence is based very closely on the fact that you have a 2-to-1. This drawing is going to make sense in a moment. That you have a 2-to-1. I still can't draw harmonic ratio there. A colon. You have a 2-to-1 ratio between the cycle that you use as your signal cycle, the 20-day cycle usually, and the cycle above it, 2-to-1 harmonic ratio, so 20-day to 40-day, and then a 2-to-1 harmonic ratio to the next longer cycle, which is the 80-day cycle. So if you have, so from our, what is called our sequence cycle, if you're familiar with the term, our sequence cycle is 80-day, and then you need a 2-to-1 I drew a colon, fantastic, down to your 40-day cycle, and then you need another 2 to 1, that didn't work, down to your 20-day cycle, okay, which is your signal cycle. So your sequence A to H remains true as long as you have a 2 to 1 ratio between those 3 cycles. If you have a 3 to 1 ratio between any of them, then your A to H sequence will change, and you get repeats of BC, DE, and GH category interactions. I think I'm correct in saying. So if you have different harmonic ratios, then that's what happens. Okay, I hope that answers your question. So yes, if you change your nominal model, you do affect the A to H sequence. If you are changing the harmonic ratio between your signal cycle and your sequence cycle. Okay, so I hope that makes sense. And David says, great long if the longer trough holds. Yes, indeed. So it's time for me to start wrapping up here. So let's speak about trading the euro to US dollar now. First of all, we should have been short for the move down into the 40-week cycle trough. And there's an interesting little point that I can make here, which has quite a lot to say about the way in which you trade Hurst cycles. So let me just do that. Let me show the FLD again. Here we go. Let me make this point. Okay. So there is our 20-day FLD and the composite model. It's all beginning to look a bit messy. But here is our cycle trough, the 23rd of September. So the first trade that we make is our A category trade. That A category trade was a very messy trade, difficult trade to make. Personally, I didn't take it because I just found it very messy. Price, as you can see, came up, touched the FLD, and then bounced around and really struggled with it. But then, of course, we get the B category trade as price comes back down to the FLD. That's B. And then C, it bounces up again. That was a really typical BC category interaction, in my opinion, as came down to form the 20-day cycle trough. You can see Sentient Trader has positioned the 20-day cycle trough a bit later over here. That's just because Sentient Trader, sometimes wants to be cautious about moving a trough too early, because that would then tell us to expect the next trough too early. So it's placed it over there. But it looks to me as if though the 20-day cycle trough probably occurred a little bit earlier. So our next trading, I see Robin ask, where's the entry for the C category trade? I'll get back to that in a moment. But our next trade, according to the FLD trading strategy, was a D category trade, a short trade as price interacted with the FLD again. So there was our entry into the D category trade, and price has come down and is proved to be a really great D category trade. It is now going to bounce out of the 40-day cycle trough, and as I've mentioned, this composite model line probably looks as if it's shifted over to the left. So we're going to get a bounce. There's the bounce in the composite model line. And so we've got a bit of a bounce, and then we're going to come back down into the November 40-week cycle trough. So there's several important things to say here. Let me see if I can fit them all in. First of all, are you interested in taking the E category trade as price bounces out of this 40-day cycle trough? Well, that's a really interesting question, and there are several comments to make about it. First of all, let's look at our composite line. Our composite line is showing a little bounce up like that before the move down into the November trough. So no, I personally, on the basis of the composite model line, I'd be a little cautious of it. This market has turned bearish sooner than I would have expected. What's my underlying trend as price bounces out of this 40-day cycle trough. And it's possible this 40-day cycle trough even formed last week, and we're seeing a bounce happen now. Let me just see if I can measure some bars. This irritating sort of switching of the windows. There we go. It's been 33 bars. So I think that 40-day cycle trough is probably going to form very soon. Bars. Am I interested in trading the bounce out of it? Not very, because the composite model line tells me to expect not a very impressive bounce. And the underlying trend for this long trade, it has a 40-day cycle going up, so that's +1. It has an 80-day cycle coming down, that's -1. It has a 20-week cycle coming -1. It has a 40-week cycle coming down -1. Okay, the 18-month cycle is probably fairly neutral at this point, and the 54-month cycle is possibly +1. But I actually never count the 54-month cycle, so we don't worry about that. So we're left with an underlying trend of -2. Underlying trend of -2 isn't really a very good time to be entering into a long trade. However, there's also the possibility, we must bear in mind, there's the possibility that this 40-week cycle trough is going to occur earlier. Is it possible that the 40-week cycle trough is going to occur now? Well, we'd probably have to look at it in a bit more detail than we really have time for at the moment. But yes, it probably is possible, in which case we would want to take this bounce out. I mentioned earlier, if price bounces from this level, then that is going to be a good long trade. And David from Trading Hurst said that we're looking at a good long trade coming up. So we should definitely stand by. But now I'm worried this is going to be the bounce out of only a 40-day cycle trough. How do I personally deal with that situation? What I personally do is I enter into a small trade, just a very small trade. If it turns out to be the bounce out of a 40-day cycle trough, it might be very disappointing. I might make a small loss on it, or perhaps a break even if it is only a bounce out of the 40-day cycle trough. If these cycles have speeded up and it is an early example of the 40-week cycle trough, then at least I'm in there with a chance to to make a profit out of it. That's one approach. Another approach is to do what I did when I was expecting the 54-month cycle trough. That is to not get in at the level of the FLD, but rather watch the shape of the first 20-day cycle. If the first 20-day cycle turns out to be a really big bullish cycle, then you would get into your long trade, or as David was probably typing, as I was saying, that one more 40-day cycle, and then you have the chance for the big trade. So yes, this analysis certainly seems to be saying that we have one more 40-day cycle, and then we've got the really good opportunity to get in for that long trade. If you're interested in sort of jumping in and out of the market, you might try and catch a very short long trade here. It might not be very good. You might try and catch the last downward move into the end of December. What you have to do is you have to ask yourself, what is my trading time frame? Am I going to be watching this every few hours, every day, every few days, perhaps every week? I check in on it. And depending on your trading time frame, you will make trading decisions on the basis of that. I said I would answer Robin's question about the entry into the C category trade. C category trades, Robin, I think you are an FLD. I think you've done the FLD trading strategy course. So know that the entry into the C category trade is very difficult. It is often very difficult, I should say. And in this particular case was fairly tricky. The ways that you get into the C category trade are, first of all, you expect the C trade when you are approaching roughly the time that you expect a 20-day cycle form in the market. So what you normally expect is you expect price to break up above the FLD, to be above the FLD and then come back down to it, find support. As soon as price starts finding support at the level of the FLD, as it did over there, at that point you stand by to in category trade. Now, there are various ways of doing it. One way of doing it is if price drops just down below the 20-day FLD, you use your 20-day FLD. In this particular case, that didn't happen. The other way of doing it is you look at your 10-day FLD, and that's why I've plotted this 10-day FLD over there. You look at your 10-day FLD and see if price has popped down below the 10-day FLD and got itself into what I call the bubble. I think you might be familiar with the bubble if you've done that FLD trading strategy course. And in this particular case, as I think you can see, we didn't have a bubble. You could and then look at the 5-day FLD. Here's the 5-day FLD. Price didn't even get into a 5-day FLD bubble. Well, it sort of did, but it did it intraday. So all of those potential entry opportunities were ruled out. But there was one very good way of getting into this trade. I happen to know because I took advantage of it. And that is you take a look at your VTLs. They don't even have to be VTLs because this is actually a VTL that breaks the rule, but it's a trend line that isn't really quite a VTL. I draw my trend lines. This VTL, as a matter of interest, breaks the rule that there mustn't be a long trough in between the two peaks. Okay, otherwise that would have been a 20-day downward VTL. It's disqualified because of the long trough in between, but even disqualified VTLs can give you good entries into your trades when you're looking for to break out of the 20-day FLD. That's out of the 20-day cycle trough, and therefore get into your C category trade. But that's not pure Hurst. I should say. Little disclaimer: that's not pure Hurst. So you can use that trend line to get into your C category trade if you are really convinced that you want to catch that trade. The other approach, of course, would have been to use a price level approach to get into the trade. Price level approaches do work, but as we're approaching a 40-week cycle trough fairly soon, I wasn't expecting a lot of bullishness out of this, so I wouldn't have done it. Robin Bailey, which pivot point would you choose in this case? That's again an interesting question, and the system that produces Hurst signals, when it I'll tell you what process it uses. Craig says artistic license. That's right. Trading. I believe trading is a bit of an art. You're probably aware of that, and it's as much an art as a science. And so, defining the pivot level, you can debate it. I'll tell you how the Hurst signal system actually defines the pivot level. What it does is okay, let me just clear some of these FLDs. When you have price coming down to an FLD, in other words, a B category interaction, and just clear that, there we go. As you have price coming down to the 20-day FLD in a B category interaction, which was the case here, and it's a fairly messy B category interaction, then what the Hurst signal system does in order to determine its pivot point is it looks at the high price since the 80-day cycle trough, which in this case was this bar over here. Okay, that's your high price. And then after that high price, it looks at when price came down to touch the FLD and find support at the FLD. And then from that bar, it finds the lowest price, which in this particular case would have been over here. And that is your pivot point for your C category trade. I hope that makes sense. Okay. Chris, let's see. I saw a question earlier from Chris, did I? Yes, any cycles are forming. Okay, well, Chris, we've spent the whole of today's webinar speaking about the Euro-US dollar, but let's go and quickly take a look at the ES. And Robin says that wasn't what you thought. Okay, well, that's the approach that the Hurst signal system uses. The important thing really is to find an approach that works for you. Just to sort of wrap up that conversation, I will go and take a quick look at the ES. there are sort of 2 points there. The one is that VTLs or invalid VTLs, so just trend lines, are very useful when you're trading with cycles. I would encourage you to look at them. They're very useful. And the other thing is when you get messy interactions, such as this interaction here. That's a really messy interaction. Price came up to the FLD, it tracked along it for an entire week and 4 days. When you get very messy interactions, you have to, you have to try to find the cycles amongst a lot of noise, and it can be quite difficult. That's the process that the Hurst signal system uses. You would have picked October the 1st for the pivot point. Yes, that's also a sensible point to choose. It's a very sensible point to choose, particularly if you're using the 10-day FLD, because of course price is bouncing out of the 10-day trough. So in fact what you're doing is you're not trading a C category 20-day signal cycle trade, you're trading an E category 10-day signal cycle trade. I hope that makes sense. I'm just going to leave it at that because that could get a bit complicated. But if you're trading an E category 10-day FLD trading strategy trade, then October the 1st would be your pivot point, is my point, the point I wanted to make. But you would be applying the of an E category trade as opposed to a C category trade. Okay, before I get too complicated and just lose everybody, let's quickly go and have a look at the ES, the S&P 500. Now, the ES, we really don't have time to speak about it because we're running out of time on the webinar, but I published a blog post to our Sentient Trader site and the Hurst site. So please take a look at that because I think this is quite an interesting analysis to consider. But let's just go back here. First of all, okay, here is default analysis, which Sentient Trader has been performing. And let me just zoom out a bit. This is the ES. It's not actually the ES. It's this sort of well, it is. It's the futures price, but I think it's SPX or something. But it's related to the S&P 500. And so here is our analysis going back to October of last year. And this default analysis, of course, August this year. And then we had a 40-day cycle trough. So let me just zoom in and look at what happened since then. So since then, very clear, very, very obvious 40-day cycle that occurred and formed a trough over there. And since then, price has really bounced up quite enthusiastically. What is the next thing that we expect from the ES, the S&P, is we expect it to come down to an 80-day cycle trough, probably sometime in the first week of November. So we are expecting price to come down like that. Let's take a look at our composite model line. I'm sure you're all very familiar with the composite model line by now. I've been speaking about it for a while. Okay, so here's the composite model line, and you can see it's done a fairly good job at describing a price action recently. It expected a higher peak over here, and it expected a lower peak over here. Now that might seem like a small difference, but it's actually quite an important difference because it indicates that the combination of the cycles isn't quite what it should be. This composite model expected a much higher peak in September, as you can see, and it expected a lower peak last week. It is now expecting price to turn around, and it should come down into this trough in the first week of November. Okay, let's go and take a look at the other analysis that I wrote about over the weekend. So read the blog post, and that would have to explain it in too much detail. But here is the basic summary of this particular analysis. This particular analysis suggests that the 40-week cycle trough actually occurred in July. And then we had a 40-day cycle that came down hard into the end of August, then another 40-day cycle that actually ended at a slightly higher point, but a very slightly higher point. It really wasn't much higher at all at the end of September. And so that possibly could have been our 80-day cycle. This is a viable, it's possible analysis. It's not a very beautiful analysis because, you know, it involves an inverted cycle. I spoke about an inverted cycle earlier in today's webinar. It involves an inverted cycle there from July to end of September. It's not a very beautiful analysis, but it is possible. And the one thing that really intrigues me about this analysis and that I really like this analysis is what has happened recently with the interaction between price and the 20-day FLD. Now, price came down to the FLD. Can you see what it did last week? On Wednesday, our price came down to within a few ticks of that FLD, and it found support there, and it bounced back up again. Now, you know, I'm pretty obsessed about the way in which price interacts with the FLD. I freely admit it. And when price comes down and touches the FLD like that and bounces back up again, you know, it might just be a kind of a chance occurrence. But I sit up and take notice, and that looks very much like a B-C category interaction. You will know if you are an FLD trading strategy trader, as many of you are, then that was, of course, our A category interaction, as opposed to an E. If we were trading the other analysis, that would have been an E category long trade, both good, profitable long trades. But that looks so much more like an A category long trade. Can you see that? One of the characteristics of an A category long trade is that it reaches its target, you know, which is about over here, and then goes on and exceeds it. That is one of the characteristics of an E category trade. It is not a characteristic of an E category trade. An E category trade usually reaches its target and then drops. So last week, I was expecting price to turn around and drop. And as it came down to the FLD, I was watching it very, very closely. It came down to the FLD and undoubtedly found support at the level of the FLD. That looks more like a B category trade, in my opinion, which means we are now in our C category trade. Okay, and of course our next trade will be our D category trade. Price comes down into the first week of November. So as I mentioned, I spent the whole of last week's webinar talking about the fact that we have different analyses, trading opportunities. And so our next trading opportunity, according to the other analysis, short trade coming down into the first week of November. And if I take a look at the composite model line on this particular analysis, what does the composite model line say we should expect is exactly the same thing. We're looking at price coming down into the first week of November. So again, we've got different analyses, but we have the same trading opportunity. Our next trading opportunity, the S&P 500 or the ES or the SPX, is a short trade into the first week of November. Of course, each of these analyses is correct, we would expect a different degree of bounce, a different scale of bounce. If this is the correct analysis, then the long trade bouncing out of that first week of November would still profitable trade, but what happens in the longer term will likely be slightly different. And let me see if I can zoom out a little bit and show you. Let me just here. Okay, let's see. There we go. According to this analysis, there we go. We have our peak in January that I was speaking about last week. So we're definitely looking at peak in January. Bear in mind the relative levels might not be correct because this might not be the correct analysis. Bob, can I analyze XAU or GDX next time? Yes, I'd be happy to. In fact, I have both of them. No, I don't. I have GDX. So we'll take a look at GDX next week. Let's spend a bit of gold again. And Robin, if the 54-month cycle bottomed August 24th, could it distort the E category wave? Yes, definitely. There was an interesting comment that I will still reply to on the blog that I posted over the weekend, asking whether maybe, just go back to default analysis, maybe this trough in August might be a much longer, a much greater magnitude trough. Could it even be 54-month cycle? Could it even be a trough of the 54-month cycle? I've been speaking for too long. Yes, if that turns out to be a trough of the 54-month cycle, it could definitely distort the E category wave and give us a much stronger E category. And I write about it fairly often. This neutral 40-day cycle over here, it's a fairly neutral 40-day cycle. It's not impossible that is the first 40-day cycle of a much longer cycle. So it is possible that the 24th of August or the 25th of August or whatever it was a trough of a much longer cycle, in which case, of course, we would be looking at more long trades coming up in the future. David at Trading Hurst, if this analysis is correct, the 20-week should fall below the 40-week. Yes, okay, so indeed, I think that was the other analysis you were speaking about. Is it? Let me go back there. Okay, there we go. So there we go. Right. So the 20-week trough, which is speaking about getting into soon. Let me just zoom in a little bit. Turn off pens, zoom in, do this. Here we go. So here's the level of the 40-week cycle trough. Is that correct? And so the 20-week cycle trough we would expect to see happening below that level. I think that's what David is saying, and so it requires a very bearish move. But I might have misunderstood that question or that point. It really is time for me to wrap up, and that's something that we can explore later and in a future webinar. Thank you very much for joining me, everybody. Thank you so much for your interest in Hurst cycles and your interest in Sentient Trader. And as always, I wish you profitable trading. Thank you for being here. We'll be back same time next week. Of course, time is changing in America over the weekend. So so make sure if you're in America or Canada, then please make sure that you check the change in time so that we can all get together at the correct time next week. Thank you very much for being with me, and I wish you profitable trading. I look forward to seeing you next time.